Welcome to CrushTheStreet.com's weekly market wrap-up. We'll start things off in the equity sector, which was abuzz with excitement over today's across-the-board market rally, with all of the major indexes posting gains. Two fundamental factors were at play. First, the Spanish government announced that its budget plan will meet deficit targets this year, and second, there is speculation that China will loosen monetary policy following an earlier influx of liquidity into their financial sector as a response to weakening global demand. However, let's put today's news items into perspective. Ever since the announcement of QE3, the Dow Jones has been flat, the Nasdaq has been flat, and the S&P 500 has been, you guessed it, flat. Today's market action, until proven otherwise, has only succeeded in keeping the major indexes above water, which is represented by the 20-day moving average. And the highs of the day are nowhere near the highs of QE3, thanks to the fact that Spain and China, who delivered the goods today, were earlier in the week the bearer of bad news, what with protests and conflicts and all. And we also need to keep in mind that tomorrow is the end of the week, the end of the month, and the end of the quarter. Some window dressing was definitely taking place, and we might see some sell-offs occur from fund managers eager or desperate to post some profits. The risk-on atmosphere in the markets got the currency juices flowing out to both the equities and the commodities sector, which was technically bearish for the US dollar. Today, it closed at 79.56 and it deflated the fresh momentum that the greenback was riding for most of this week. Another pressure point was the euro, which responded positively to the Spanish announcement and saw it slide right back into the 129 level. The oddball currency in this fiat mashup is the Japanese yen, which was gaining strength in lockstep with the dollar earlier this week. It's unusual because these two currencies almost always have an inverse relationship towards each other. Today, the dollar lost strength against the yen, meaning that it now takes more dollars to exchange the same amount of yen. Let's move over to the precious metals. Throughout most of this week, the PM sector was under noticeable selling pressure as it trudged along in choppy chart consolidation. The weakness was in part due to the earlier technical strength in the US dollar, where it was receiving an influx of demand from foreign investors wanting to seek shelter from a deteriorating Europe. If we look at the technicals for gold, we see that this week's price action veered off course from the current trend channel, where it was headed straight towards the 20-day moving average before today's rally. This positive movement is aligned with the primary trend, which is very bullish, and the fundamentals of central bank money printing and the rise of the fear trade is very supportive of higher prices ahead. The when part, however, is the real mystery. Upon closer examination, we see that today's rally occurred on lower volume levels than yesterday, and I believe that this is a risk factor to consider. In the weeks prior to QE3, we saw positive buying volume enter the market at incrementally greater numbers, with the bulls massacring the bears and finally culminating on that fateful Thursday morning. Since QE3, we find that the bulls have lost some momentum, and while they still have technical control of the market, the bears are clearly coming out of hibernation. If we take a look at silver, we find a nearly identical pattern with gold, but with a bit more volatility, with Wednesday's intraday bottom actually touching the 20-day moving average before moving significantly higher with today's rally. One of the concerns here is again the volume, where the rally occurred at a level slightly lower than yesterday. Also, as with gold, positive buying volume has been on the decline since the announcement of QE3. Another concern is that if we do move to the upside, there's not much room for growth before we clearly get into overbought territory. As for a forecast into what we can expect going into next week, a strong argument can be made for all sides. Fundamentally, nearly every economic indicator has nothing good to say about the global marketplace, which of course puts pressure on the banks to let loose the printing press, which inevitably gives investors more incentive to participate in the fear trade. Technically, the price action has been astonishingly weak, considering that major economic powers have announced programs of monetary stimulus, which gives further suspicion that a correction could be likely. And finally, there is the conspiratorial side, which notes that tomorrow is the end of the third quarter, and many fund managers haven't done so well this year. A concerted, or dare I say, coordinated sell-off of the metals could be just what the doctor ordered. And that will do it for this edition. Thanks for watching, and we'll see you next week.
For more unconventional ideas, please visit CrushTheStreet.com.